So welcome back to day 3 of the Investing in Resilience Conversation series. My name is Mothanna and I lead SDG Impact in Jordan. SDG Impact is a flagship initiative of the United Nations Development Program, and Jordan is one of the 11 countries in which it is being piloted. The global program outlines 3 pillars of work. The first, impact management, which is where we work with companies on measuring and reporting their impact. The second, impact intelligence, is our research work. This is where we provide investors with the tools, the insights, and the data to be able to identify SDG-aligned investment opportunities. And our third pillar, impact facilitation, is where we work with investors to connect them with these opportunities. What became clear to us shortly after we started work in Jordan is that we needed to add a 4th pillar, and that is impact awareness. There's a lot of misconceptions around the SDGs and around the notion of impact. One challenge relates to the ambiguity of the language. A lot of people just hear SDGs and they think this is the work of nonprofits, or these are challenges that the government needs to solve for. Another myth is the misconception that businesses think this is what they do as part of their CSR efforts. So this is activity they would do on the side, or they use it as a marketing tool, or as a tool to be able to get in development money. A third myth is that investing in impact or investing in the SDGs results in lower returns. Companies using the SDGs as a marketing tool or as a guide to their CSR or as a fundraising tool are not the companies we're talking about. These are not the companies we're advocating that you invest in. We're talking about companies solving for the societal challenges outlined by the SDGs. We're talking about a thematic investment approach that is focused on companies that solve for the scarcity of water, food security, climate change, energy, affordable and quality education and healthcare, and business models that are designed to solve for the needs of the people at the bottom of the pyramid and provide them with decent work. Also, companies who at the heart of their business model is the purpose of solving for these societal challenges. And intentionality is key here, having the actual intention to create that positive impact. And if that is the purpose that drives them, financial returns will follow. Because these themes, and we spoke about thematic investing quite a bit yesterday, are structural growth areas. They're addressing real and scalable market needs. These companies combine financial return along with societal and environmental impact, and will continue to do so in the long term. Investing in these areas contributes to long-term economic resilience, which is what is needed to create an enabling environment for businesses to flourish, because of the simple premise that businesses cannot flourish in ailing economies. We'd like to play a 2-minute video for you that'll share a bit more about what we do at SDG Impact and how the SDGs can be used to define investment opportunity areas in Jordan. So before we turn to today's panel, I'd like to introduce the CEO of the Social Security Investment Fund, Mrs. Kholoud Al-Saqqaf, to say a few words. Kholoud?
Thank you, Rasha, very much for the nice video and for the nice introduction. And good afternoon, honorable speakers and guests. Now that we reached the last day of our 3-day sessions, personally, I enjoyed the topic discussed in the past 2 days, and my team did as well. And we look forward to learning more today. I promise you that we took a decision that we're going to make internal meetings so that we can revisit our internal policies to see if needed be to reflect what we have learned for the past 2 days and for today. I also want to welcome our special guest, His Excellency Mothanna Gharaibeh, Minister of Digital Economy and Entrepreneurship, and thank him for being with us today. Also, allow me to extend my sincere gratitude and appreciation to our esteemed Prime Minister of Jordan, Dr. Omar Razaz, for his patronage of this event. And a word of sincere gratitude is due to the UNDP staff, and in particular to Sarah Ferrer-Olivia. I don't know if I'm pronouncing it well, but Sarah, excuse me if I didn't, Sarah. Sarah is a dear friend to me, and Mr. Akim Steiner, and the entire UNDP staff in Jordan and abroad for their valuable contribution towards the success for this insightful forum. A sincere thank you also for Rasha, Manna, and the SDG Impact team. And last but not least, I want to thank all the panelists and speakers from the globe who added their immense, valuable, and insightful input to share it with the rest of the world. This is the true hallmark of solidarity. I just have one request from the panelists, and that is to accept our invitation to remain in touch with each other for future cooperation. And also I have another request for the UNDP team, is to kindly make sure we all remain in touch with each other. I thank you all, and I look forward to the upcoming session and wish you a very pleasant afternoon and very informative and interesting session. Thank you, Rasha. Thank you, Sarah. And thank you all. Thank you.
Thank you, Kholoud. It's been our pleasure working with your team and putting this event together.
Thank you.
We hope to be working together going forward.
You did a great job. Thank you. Thank you very much.
Shukran. So those of you who have been with us over the past couple of days know the logistical notes, but let me just go over them in case we have some first-timers. Simultaneous translation is available. If you're a non-Arabic speaker, please go ahead and select English from the interpretation channels. And if you require Arabic interpretation, please select Spanish. So it's still selecting Spanish to hear us in Arabic. And in terms of agenda, it's like the days before, up until 4:30, 4:40, that's going to be the moderated segment of the conversation. After that, we have a short intervention by His Excellency Mothanna Gharaibeh, the Minister of Digital Economy and Entrepreneurship in Jordan, and then we'll move to audience participation. You can make use of the Q&A tab to post your questions. You can post them in Arabic and English, and you can upvote the questions so that we make sure we prioritize the favorite questions. And I think at this point, if I can invite you to turn on your videos, Akif, Anette, Sundeep, and Cameron, while I introduce our moderator, Akif. Akif Merchant is a manager at Convergence, the global network for blended finance, where he is responsible for capacity building among clients ranging from donor agencies, development finance institutions, multilateral development banks, and philanthropic organizations. Akif, over to you.
Great. Shukran, Rasha, and many thanks indeed for that kind introduction. And good morning from here in Toronto. Good afternoon to all of you in the Middle East. Many thanks indeed, Rasha, again. And today's session is really, the last of a series of conversations that we've been having this past week with the pension fund community on investing in resilience. We spent day one talking about investing in extraordinary times, day two about investing in sustainability, and today's session is all about investing in emerging and developing markets. Now, two things that stood out for me that I think are germane to this discussion that I wanted to highlight to all of you the last few days of discussion. One is, the changing demographics in developed countries, or what's called the inverse pyramid dilemma, coupled with a low interest rate or negative interest rate environment, is putting an immense pressure on pension systems in the developed world. In many ways, that could be looked at potentially as a tailwind for investing in emerging markets and developing countries as pension funds search for yield. The second interesting point highlighted over the last few days was the fact that pension funds are prioritizing investing with impact and thinking about this strategically and really placing this high on their agenda. Impact is a tremendous opportunity across emerging and developing markets, specifically if you frame it within the context of the SDGs and take into account the fact that we have a $2.5 trillion SDG funding gap per year in emerging and developing economies. Now, emerging and developing markets, of course, are in the process, as you can imagine, of rapid industrialization, dynamic economic development, in contrast to developed countries where there are limited business growth opportunities in a sense. Yet, emerging markets remain significantly underrepresented in the global investment portfolios of pension funds. With a focus on the MENA region, this session is really, will examine the risks, the barriers to pension fund investing in emerging and developing countries. And we'll discuss recommendations for policymakers from developing countries as to how they can attract and reassure investors and examine some of the world's leading pension funds structuring transactions to mitigate some of these challenges that are inherent in these particular geographies. So to unpack all of these different themes, we have a very distinguished and exciting panel of speakers. To kick things off, we have Anette Eberhard. Anette is a managing director at IIP. IIP is the Institutional Investment Partners in Denmark. It's an alternative investment platform for institutional investors investing in private funds. IIP manages around US $10 billion on behalf of institutional investors. And IIP was stood up by PKA, which is the labor market pension fund in Denmark. And of course, we'll chat about that a little bit later on. Secondly, we have Cameron Khosrowshahi from the United States Agency of International Development. Cameron is the director of the USAID Invest Initiative, which is a $167 million collaboration platform that aligns the skills and capital of donors, investors, and corporates to achieve development outcomes. Cameron also wears a second hat. He is the lead for the MEDA initiative, which is the Mobilizing Institutional Investors to Develop Africa's Infrastructure Initiative, a collaboration between USAID and the Africa pension communities that has mobilized $1 billion in institutional capital commitments. And last but not the least, we have Sundeep Raichura. Sundeep is the CEO of the Zamara Group and also the chairman of the Kenya Pension Fund Investment Consortium, a group of 14 leading pension funds in Kenya with an asset base of over $2.5 billion. Cameron, if we may start with you, and if I may come to you to kick things off for us. Cameron, could you start by describing a little bit about the MEDA initiative and specifically talking to us a little bit about potentially how this initiative could be replicated for the MENA region?
Sure. Thank you, Akif, and good to be with you. So I'd rather tell a story than throw up a bunch of slides, quite frankly, because I think that narrative is more interesting for people. About 6 years ago, I attended a conference in Chicago of US institutional investors, and it was a conference on Africa. and some people are scratching their heads right now, a conference on Africa in the United States involving US institutional investors. It wasn't exactly on our radar screen as a development agency. We thought that Africa was too far afield for the US institutional investor community, which has a large part of their assets, as you said, concentrated in developed markets. But there they were, having a day entirely devoted to Africa and investments in Africa, probably in terms of risk perception, the riskiest market in the world as far as US investors were concerned. And I think that data point was telling. Essentially, the market we realized that the market was already moving towards emerging market investments. So you talk about a tailwind, Akif. I would call it a hurricane force wind at this moment. Why? Well, we all know that the interest rates, global interest rates, are quite low. So the returns in developed markets are very weak. In the US, many pension funds have an 8% hurdle rate, which means they have to achieve 8% to pay their retirees. And there's nowhere near that level of return in developed markets. Add to that, in the US case, the fact that many pension funds are underfunded, i.e. the promises have been made on funding levels, and in many cases they're only 40 or 50% funded. That puts additional pressure for yield. Add to that the global pandemic, of course, which many people see as a reason for global investors to step back from emerging markets and invest in the markets that they know. On the contrary, in the United States, that has hollowed out tax revenues for local entities, which means they cannot support their pension funds in a low return environment with additional tax revenue. All of these winds, so to speak, have produced a gale that is certainly pushing pensions towards emerging markets. The volatility in mainstream markets has also pushed them to look at least correlated markets, markets that don't move in the same direction as mainstream markets. And a place like Africa, a place like the MENA region, they are fairly uncorrelated compared to other regions in the world. Now, US pensions, in our experience, do not yet invest first and foremost for impact. They invest for risk-adjusted returns. They need to finance the retirements of all of their retirees. And I would argue that even pension funds in Europe who have more of an impact lens than US firms, first and foremost, they're going to invest for returns because their number one fiduciary commitment is to their retirees. But as Rasha mentioned, just because you have an investor who's concerned with return first and foremost doesn't mean you can't channel their dollars towards investments that produce impact. And that has been the foundational theory of change behind META, where we are driving US investors to the continent, in many cases physically through trips, to meet with their African counterparts, to form relationships, to bring the perception of risk down from where it is, and to show them projects and opportunities that can drive returns, but can also contribute to impact across society. So I think the outcome has been a pleasant surprise for us once we've taken US trustees, CEOs, CIOs to the continent, they have been pleasantly surprised at how sophisticated the continent is, and the growth of the African growth story, which I think are very analogous to the growth fundamentals in the MENA region. Young populations, growing economies, a strong consumer base that's growing, almost the flip of the fundamentals in developed countries. So this fits into our overarching strategy of how we can mobilize scale, to your point. If you want to mobilize scale and you have a $2.5 trillion gap each year to achieve the SDGs, you really need to go to the largest pools of capital in the world, and that are institutional investors.
Great, Cameron. And maybe if I can just, have you build off on that story. How do you think an initiative like MEDA, focusing on Africa, could be replicated within the MENA region? Because I think there might be some sort of interest in having something analogous to what you're already doing with MEDA.
Thank you for reminding me of the second part of your question. Well, all U.S. institutional investors are in the end global investors. Why? Because investors want alpha, return, and beta, diversification, right? So they're not just going to invest in Africa. They're going to want to invest across the world so that they're diversified and they can manage risk. North Africa, the Middle East, is a more developed market, quite frankly, than Africa in many ways, less opaque than Africa in many ways. So if you can sell, quote unquote, US institutional investors and global investors on Africa, you can sell them on MENA. And so in that sense, I think MEDA, although we started with Africa, probably the toughest region in the world, we've now proven the case for almost every emerging market region in the world. And we definitely like to see it replicated. And I think it would be easier to replicate it in a region of the world that, compared to Africa, has larger economies, more transparent markets in many ways, and has institutions on the ground, both pension funds and sovereign wealth funds, that are also investing and can invest alongside global pensions and give them the comfort they need to make investments. In November, I was in Abu Dhabi for an investment summit on Africa hosted by the Abu Dhabi Investment Authority, one of the largest sovereign wealth funds in the world, perhaps number 2 behind Norway. They are also a investor, of course, for impact as well as return. And you have some very large institutions in the Middle East, both government and quasi-government, who can lead the way, and we'd be happy to partner with them, with our US community and with hopefully our European friends, to drive both impact for MENA societies, but also return for developed world retirees and pensioners.
Great, Cameron, thanks for that. So I think we already have some collaboration activities there. Sundeep, if I may come to you next, it would be great if you could kick us off by telling us a little bit about the story of the formation of the Kenya Pension Fund Investment Consortium, and maybe spend some time also talking to us about how KPIC partners with international pension funds and the pension community globally.
Thanks very much, Akif, and for allowing me to share the KEPFIC journey. We've had an exciting journey so far, achieved some important milestones, and have a very ambitious plan on what we want to achieve in the next 3 to 5 years. So currently we are a group of 15 pension funds in Kenya who've come together in this consortium. And in the next 6 months with our outreach program, we should double that number and have about the pension funds would have more than 4 billion in terms of assets under management. And we have committed, each of us have committed to invest 5% of our assets into alternative assets and infrastructure in the next 5 years, and to work with US pension funds, UK pension funds, and South African funds to facilitate deployment of more than $250 million in the East African region. So this is our plan. And I think it'll be helpful, Akif, just to give you a little bit of background to KEPFIC. The pensions industry in Kenya, by global standards, at about $13 billion is small, but it's been growing rapidly and is expected to continue to grow. But if you look at the investments of these funds, more than 80% is invested in traditional asset classes. So we've got fixed income and equities. What is invested in fixed income, more than 50% of that is in government securities, and there's only a handful of equities. So there's very limited diversification and very little investment in the real Kenyan economy. So and as the industry has grown, as individual pension funds have grown, there has been an appetite and a growing interest in exploring alternatives. Now, at the same time, we have a huge infrastructure financing gap in Kenya and indeed in Africa. And as a country, we've got a fairly robust public-private partnership framework and legislation. We have a decent pipeline of projects in need of financing across various sectors. And what's been happening in the last 3 to 4 years is that there's been a lot of work in introducing infrastructure as an investable asset class for pension funds and as an attractive investment in its own right. And we have a relatively sophisticated institutional investor base that has not been tapped. And so we're grateful to the World Bank. I mean, they facilitated a series of workshops in Nairobi to bring pension funds and other institutional investors together. And that led to the creation of KEPFIC. And the rationale is very simple. Investing in alternatives and infrastructure is complex by its very nature, daunting to even the larger pension funds, requires costly research, due diligence. The ticket sizes are much larger than the capacities of individual funds or the regulatory limits. And by coming together, we can benefit from economies of scale, have a higher bargaining power, have a seat at the table, lower risk, and also present ourselves as co-investment partners for global pension funds. So we have a mission to invest in core infrastructure, supporting agriculture, supporting trade in Kenya and East Africa, supporting social infrastructure. As a country, we have an ambitious affordable housing program, and this is something that we're also looking to participate in. So as KEPFIC fund members, we achieve 3 objectives. One is diversifying our portfolios, something that we've been needing to do. Investing in assets that are uncorrelated with the rest of the market and hopefully getting more stable long-term returns, but also enabling us to play our rightful role in the economy. And as Cameron has said, look, we are not impact investors per se, but I think quasi-impact investing is a word to use because infrastructure development is a very key driver of progress in sub-Saharan Africa. It's a very critical enabler for trade, private enterprise, and indeed the attainment of the SDGs. And we see ourselves as playing a role in achieving that. Perhaps I could talk about some of the milestones, Akif, that we've achieved so far as KEPFIC. So firstly, it took us more than a year to get registered as KEPFIC because the government was a little bit nervous about us using Kenya in the title. I mean, their view was that this should be reserved only for government entities. And we were very clear. KEPFIC is a partnership of public as well as private sector pension funds. This is not a public enterprise at all. We're very pleased with the technical assistance that we've received from the World Bank. We were very keen that we have a proper framework for governance as well as investment at the outset. So we benefited from technical expertise there. I'm happy Cameron is on this meeting because we have a relationship with USAID and they are funding our activities over the next 3 years, of course, subject to us achieving certain performance indicators. Now, very importantly, on the regulatory front, we have been at the forefront of lobbying policymakers for legislative change. So 4 years ago, we were able to achieve a change to our investment guidelines to permit investment in private equity, which was not explicitly recognized. And just last week, I'm very happy that infrastructure has been recognized as an asset class in its own right in our investment guidelines, and pension funds can invest in debt for infrastructure investment up to 10% of their assets. Cameron talked about US pension funds visiting Africa. So last year we hosted a delegation of 25 US pension funds and asset managers. We had a chance to showcase some of the investment opportunities here, and there's some work going on with the US pension funds. Now we have a formalized partnership with MEDA to facilitate co-investment by US pension funds, and also for capacity building for trustees and asset managers in Kenya. And we're really excited with this partnership. The other thing is that although currently we are a Kenyan consortium, we have reached out to regional funds. So we've reached out to the large social security funds within the East African community. So we're hoping that this will become an East African initiative very soon. So Akif, this is an initiative, it's by pension funds, for pension funds. We feel it can show what focused and organized pension funds can achieve by coming together. And we hope this is a model that can be replicated by many other countries, not just in Africa, but perhaps in the Middle East and North Africa as well. Thanks.
Great, Sundeep. Thank you for that story.
Would you mind if I just interjected real quickly, just to build very quickly on, on what Sundeep said?
Go ahead, Cameron.
I fully agree with Sundeep. This, I think, may be the model. There's already a consortium coming together under Batseta's leadership in the South, in Southern Africa. And the MENA region is well positioned to bring together a local consortium there with some of the leadership that they have. The US pensions would be very much interested in that, right? Because you have local knowledge. I'll give you a perfect example. The sukuk market in the Middle East is poorly understood in the US. That's an instrument that could be very interesting, and a market that could be very interesting for US investors as long as they begin to understand it. So I think this is the model for both the rest of Africa as well as the Middle East.
Indeed, which is why we wanted to have the both of you on to talk and tell us the story of MEDA and KEPFIC, because I think there's a lot of replicability potentially in these two models. Annette, if I may come to you now. It would be great if you can introduce IIP to us, talk about the relationship between IIP and PKA, because I think that's an interesting story there. And then maybe you can tell us a little bit about IIP's emerging markets policy and strategy as it pertains to PKA.
Thank you, Akif. Of course, I would like to do that, but I think before telling about the PKA strategy on emerging markets, I should also just clarify that I have been, before joining IIP 2 years ago, I was the CEO to the Danish Export Credit Agency, issuing debt and guarantees for debt globally, and also to projects in emerging markets. So I have been working with emerging markets for about 18 years before joining this private equity fund of funds, which in many ways is not very much in emerging markets, as the former presenters have already said. I have also been part of the board of public listed and government owned companies for many years, and since the last 2 years I have been a member of the investment committee of the Danish SDG investment fund, and I think that's also good to know sort of before I clarify about the PKA. And not least, I would like to tell about what I find a very innovative Danish model to try to incentivize pension funds to invest in emerging markets. So Dana, if I can ask you to put up my presentation, it's only 4 slides, but I think the last slide it's easier to illustrate the Danish model with a slide. So please skip to this one. Thank you. No, not this, the former, please, slide 2. Thank you very much. IIP is owned by PKA, and PKA is as the slide tells you, a Danish labor market pension fund with 320,000 members employed primarily in the public sector, healthcare sector in Denmark. And I think it's fair to say also that about 90% of the members of PKA are women. And that might explain why. And if Dana, you skip to the next slide. Being many women owned or members of PKA, I think that might be one of the reasons why a few years ago, the board of PKA has identified 7 of the Sustainable Development Goals, which they want to give special emphasis. And I could also say that the PKA has invested in climate change and emerging markets ever since 2005. And I think they were very early movers in that direction. And a few years ago, the board set goals to investments in climate-related investments, and you can see the target on the down right-hand side, 6.7 billion euros out of 40 billion euros. That's about 15%. They want to invest in climate change globally. This to illustrate PKA's commitment to performance. And that's not only performance money-wise, but also performance to make a difference around the world. The investments that PKA has been doing since 2005, they have done through different Danish and global entities that are specialized in investing in emerging markets. Could be smaller Danish funds that have specialized in microfinancing, things like that. Could also be infrastructure investments globally, including Africa, I think also actually in Jordan. So that's part of the DNA of PKA's investment policy and investment strategy. And finally, Dana, if I can ask you to turn to the last page of my presentation, because I think I would like to also demonstrate a special model that has been built in Denmark since 2012, where IFU, a Danish DFI, which I think many of you might know, back in 2012, they invested, or they established the Danish Climate Investment Fund. And later on in 2018, they established the Danish SDG Investment Fund. And to both funds, quite a few number of Danish pension funds, but also private investors, as you can see on the bottom left-hand side of this slide, have invested in these funds. And the way IFU and the Danish government actually attracted these private funds to finance in the SDG fund and the Climate Investment Fund was that they established what we call a preference return model, which is illustrated on the right-hand side of this slide. So you can see that the A shares, that's the light blue line, they have a preferred return until the returns reach 6%. And first after that, the B shares, which represents the government shares, will be sort of honored to participate here. And I think one of the reasons why I was invited to participate in this seminar today is that some of you have heard me speak about this preference return model or otherwhere, or at least in Paris this spring. So I hope I can inspire others and other governments to replicate this model, because I think it has shown to work pretty good in Denmark at least. So thank you.
Great, Annette, thanks for that. As you know, I'm a big fan of the Danish SDG Investment Fund, which is built on the Danish Climate Investment Fund. And I think you hit on an interesting point about how this particular model has some sort of government intervention that really changes the risk return and makes it worthwhile for pension funds to participate in emerging markets and these particular transactions. And if I may just stay with you for a second, as part of PKA and IIP's work, what percentage of this alternatives bucket is taken up by emerging markets, and how does MENA fit within that mix?
I would say that in terms of emerging markets, it's not very much. I think it's about 2 to 3%, which is in emerging markets, and quite a large part of that is infrastructure investments in emerging markets. I could say that I think many of you might know the famous wind turbines in Lake Turkana in Kenya. And the SDG fund is part of that, and thereby PKA is part of that investment. But there are also a few other infrastructure projects in that. So I mean, all-inclusive infrastructure and other investments like microfinancing, education in the northern part of Africa, and so on. I think it's about 2% only.
And do you have a sense of within that 2%, what piece of that mix is for MENA?
I'm sorry, it's not that much.
Not that much.
I think it's pretty much close to zero.
So we've got some work to do then to bring that up and bring that higher maybe.
Yes.
And that's also why I guess we had to have this meeting, because we need to collaborate and obviously work together. Cameron, if I may come to you to sort of speak a little bit about the capacity of global pension funds to understand the MENA region and indeed, emerging markets and developing countries. Oftentimes when I speak to the pension community, globally and or specifically in the developed countries, there is often a lack of coherent understanding of emerging markets. Whether you talk to them Africa, they might understand, or they might look at East Africa and think that's all of Africa, or maybe the Gulf and extrapolate that to be all of the MENA region, while there are nuances within the MENA region, while there are nuances within Africa. So Cameron, maybe from your perspective, what sort of capacity and expertise is required by pension funds in developed communities, in the developed world, to understand emerging markets and to take advantage of all these opportunities? Because we can develop the opportunity side, but we really need to develop the capacity for these funds to understand that other piece. And I think you do a lot of work in that particular area. So what do you think is missing?
That's a great question, Akif, and it varies. There's gradations of capacity. I think the first element of it is the operating budgets of the pensions to actually devote resources to that capacity so that they can educate themselves and make informed decisions. In the US, there's very little capacity. There's very little resources to devote to that capacity. All the resources have to go into investments. So what the pensions typically do is they hire consultants who augment that capacity and bring some expertise to the table. But that expertise is often limited to what the consulting economy in the US knows, which is developed markets and US markets. So we're working to expand that knowledge through various other players. MEDA Advisors is one entity that we have helped stand up and is advising not only Sundeep to augment his capacity, but the US pensions themselves have capacity issues, particularly around emerging markets. I think the situation in Europe could be different. There may be more dollars to devote to capacity. I'm not sure. Certainly in a place like Canada, for example, the Canadian pensions do devote more resources to their own internal teams that really do bring a fair amount of sophistication to the table. And so that's why you'll see an Ontario Teachers and a CDPQ do more sophisticated type direct transactions than you would a US pension. A US pension needs an intermediary. It needs a fund manager or a capital market to make an investment. They're relying on that intermediary's transparency and capacity to make the investment. I suspect many of the European entities are in a similar position, but not all. So I think one of our goals with the META initiative is really to develop the system, to broaden the ecosystem. The pensions may not have the resources to put into these types of skill sets, but if there are firms out there that have broad knowledge of different regions of the world where the opportunities are, that can give the pensions the comfort and the visibility to make investments, that drives the dollars into those regions of the world. It's extremely important to broaden that knowledge. One element of the crisis and the pandemic and the slowdown across the world that has hit home with at least the US community is that volatility is everywhere. It's not just in emerging markets. So you better diversify across the globe to manage that volatility. So there is an uptake of demand for this expertise. For the time being, it's going to have to sit outside the pensions and not within the pensions. But what we can do is augment that visibility and expertise by actually taking the pensions physically, their leadership, to these markets and showing them the sophistication of the markets and the partners on the ground.
Great, Karen. So what I'm hearing you say is, if we want to see a lot more activity and interest from US pensions in the MENA region, of course, we need to increase their comfort levels, build up their awareness, provide them with access to deal flow, and partnering with local pension funds on the ground in these particular regions, specifically in MENA, is a good way to build that bridge and help potentially reduce the gap between the perception of risk and, of course, the reality of risk.
We've already started that, actually. In January, before many of us couldn't travel anymore, I was in Tunis with several of our pension executives for the Prosper Africa conference. And so we've started that exposure in baby steps. Of course, now with the pandemic, it's difficult to bring them there physically, but that dialogue has continued, and we hope to accelerate it.
Great, and I keep bringing this up because I think there's a tremendous opportunity to collaborate with the folks in the MENA region and with pensions in the MENA region. So I think there's a lot of tangible learnings from what you guys are saying that I think our colleagues at SSIF and other pensions as well can take away from that. Sundeep, if I may come to you to move on to the topic of infrastructure, because I know it's a topic of interest to our colleagues who are listening in. I was reading the OECD annual survey of large pension funds and public pension reserve funds, and I noticed that that no organization surveyed reported infrastructure investments in the Middle East and the MENA region and Africa. So Sundeep, maybe from your perspective, because you spoke about regulation earlier as well, and I know we have regulators on the line. What can regulators and policymakers in the MENA region, do to convince international pension funds that this particular, asset class, infrastructure in MENA, is indeed attractive? And maybe you can sort of, talk about that experience in the context of Kenya and what you've learned that can be perhaps replicated in MENA.
Yep, certainly, Akif. I think the regulatory flexibility is a very key point, and that's something we've been able to accomplish in Kenya. But at the same time, this perception of risk of investing in emerging markets in Africa, it's something that needs to be tackled well. And I think, the narrative of most projects in Africa failing or not even making it past the due diligence phase, that narrative is changing now, and we've got well-structured projects, decent pipelines in place. What governments need to talk more about is conducive legal legal environment, the level of exaggeration of political risk within these countries. And even the risks, I believe they are well compensated by the returns that pension funds earn, right? So I think it's a double, one initiative is obviously regulatory flexibility, promoting the country environment, and having investable projects that have been through a good due diligence test. Having local investors participating is very key, and therefore, that is why the government is very actively engaging with us as KEPFIC, because they see the possibilities that we can bring and the comfort that we can bring as anchor investors for global institutional investors. So I think it's a combination. There's no easy fix, but there's work to be done in terms of the levels of risk, which I believe are exaggerated, and returns that more than compensate for the risk that is being taken. And that's the message that needs to be given out there.
And just staying on that topic of risk, Annette, if I may turn back to you, given your vast experience in emerging markets, there's always this challenge of the perception of risk, the reality of risk, but then we also hear about lack of investable opportunities. Individual opportunities might be too small. We hear, of course, about currency risk, big challenge there. So in your experience and working in emerging markets, what are some other barriers and challenges, in your opinion, that impede pension fund flows into these geographies?
Akif, thank you for that question. I think I would like to just go a little back to the question concerning capacity, because I'm totally agree with Cameron that it is hard to sort of build capacity within the pension funds, being specialists in different kind of asset classes and also different kind of geographies. So the way that PKA and I think many other Danish pension funds have worked with that building capacity is actually to pool their sort of investments with IFU. Many of us have invested with Actis. That is not, this is not allowed, I think, but anyway, Actis is a very good also emerging market manager. There's a Danish manager called My Invest that has been doing lots of emerging market investments as well. So what we have done at PKA, and I think it accounts for the Danish pension funds, is that we pool our investments in emerging markets with people that are specialists, and many of them, especially IFU, are also present in the different emerging markets. And that's the way sort of to be able to handle the risks that at least is perceived, as you say, in emerging markets. And then going back to your question to me, the barriers and the challenges, and I think you are very right, sort of dividing the question in perceived risks and real risks, because having been the CEO for the Danish Export Credit Agency for 10 years, 11 years, I think, I must say that the perceived risk is much higher than the real risk. I think we very much realized that during the financial crisis from 2009 until 2014, where, of course, being backed by the Danish government, the Danish ECA had to continue to issue loans and guarantees also to emerging markets. And actually, the results was pretty good. So the perceived risk was much higher than the actual risk. And I can tell you because I still follow them. And I think one of the ways to sort of overcome the barriers and the challenges could be for private pension funds or private pension funds as such to work together with some of the DFIs, the MFIs, the ECAs, and talking about the MENA region, not least sort of the regional DFIs, MFIs. I know African Development Bank, there's also something called Asian Development Bank, and so on and so forth, because they have all the instruments that you could put together to sort of mitigate not only the perceived risks, but also the real risks. And I think I've been with EKF, the Danish ECA, for 18 years, and it's still in my heart, and I think it will be in my heart forever, because these instruments, ECAs and DFIs and MFIs, are so strong together. And sometimes it is also good to sort of use the blended finance instruments as well. So I would very much encourage the private sector to work together with the public sector kind of institutions, and be careful not always wanting to invent something new, because it might be there already. So I think I hope that is some of the answers to your question.
Great, Annette, thanks for that. And I absolutely second the point that there is a lot that can be done to leverage the capacity of regional MDBs, DFIs, of course, the Islamic Development Bank in the MENA region, to do a lot more together to get some of these transactions off the ground and to get some of these transactions funded. So that's another practical solution. So thank you for that. And I know you mentioned blended finance, so maybe we'll turn to our blended finance expert, Cameron, to unpack a little bit of this particular approach, because I think it has some bearing on this perception and reality of risk, specifically around risk mitigation and return enhancement. So Cameron, what role can blended finance play in providing these pension funds with some degree of comfort in investing in emerging markets in the MENA region? And how should this structuring approach be deployed in a way that it doesn't distort markets as well? Because that's something I think we also need to be careful about.
No, that's a very good question, Akif, and you hit it on the head, which is there's a fine balance, right, between distorting markets, providing investors with an opportunity to deploy in these markets, but not subsidizing their risk too much. Because at the end of the day, their job should be to take risk. And quite frankly, our MDB community and DFI community, their job is to take even more risk. And they should probably do that a little bit more. So just stepping back to some of the comments that have already been made, I think Anette and Sundeep mentioned that well-structured, poorly structured projects in emerging markets that narrative is beginning to change. I would argue, and this is getting to your question in a roundabout way, I would argue that that narrative has been false all along. Why? We have the data. There is a Moody's study out there that shows that default rates in emerging markets are lower than default rates in North America for infrastructure projects. So I think there is a very, very high perception, to Annette's point, of risk, a very perception of very high risk that doesn't correlate with reality. So when investors come to me and say, how can you take away some of that risk with blended finance for me, my first question is to understand better whether they are talking about their perception of risk, which will not be taken away by blended finance, or the actual risk. Having said that, I think there is a role for blended finance here. By the end of the year, we will close a $250 million transaction guaranteed fully by our DFI, the DFC, in affordable housing in West Africa. It will be the first time that an African issuer comes to the US market for liquidity at a time when the US market's cost of capital is far, far lower than Africa's. We feel that we need to demonstrate to the market that African risk is low. And I think for the first few transactions of a certain kind in a certain asset class, that's important. But then the job of the donor is to step back and to let the market price that risk accordingly. Because often when you push that first demonstration transaction across the finish line, we'll get an accurate pricing of risk by the market that comports with reality and not perception. And then you can have the market take over and donors can step back and use their resources elsewhere to crowd in the market.
Absolutely. And I think that's even more pertinent as donor resources, perhaps because of the pandemic, will be reducing over time, but the needs definitely will be increasing over time. And so I think that this particular approach, again, also has some tailwinds going for it. Sundeep, if I may turn to you a little bit, because you work with a lot of and interact with a lot of international counterparts. Pension funds globally have some flexibility to allocate a material proportion of their assets to alternative asset classes in developing countries, but of course, they face certain regulatory risks and challenges around tradability, liquidity, emerging market caps as well. So how do you think, in your experience and interaction with them, does that affect the nature of the alternative assets that they are able to select in emerging markets?
Yeah, I mean, Akif, this is a key issue because packaging the solutions, packaging the investments is very critical to their uptake by global institutional investors. And we've had situations in Kenya where we've had a well-structured, well-designed solution, but because the institutional investors we were approaching could only invest, for example, in a debt instrument. A lot of the investment opportunities in Africa, for example, are not brownfield. I mean, they're greenfield, and by their very nature, I mean, there's possibly levels of equity exposure that one needs to take. So packaging those investment options, I think just going back to Cameron and Annette's point about guarantees again. So some of the things that we brought in are sovereign guarantees, or even the institutions like World Bank have stepped in that if there is a default on a cash flow, for example, it would be, the timing of it would be guaranteed by a donor institution. So I think creating the right structure around these is very critical.
Sundeep, thanks for bringing up the point of guarantees. I'm a big fan of guarantees because I really believe that guarantees really have the power of reducing the gap between the perception and reality of risk that we're talking about as compared to maybe other instruments. Annette, just if I may turn to you a little bit to talk about within the context of Denmark. What do some of these regulatory caps look like pertaining to Denmark in terms of investment limits or portfolio ceilings for certain geographies and certain sectors? Maybe if you can talk a little bit about that, that would be instructive as our colleagues in the MENA region look to partner with their developed country counterparts. I think understanding investment limits, portfolio ceilings, and what you can and cannot do, I think also is very helpful. So maybe you can talk about that in the context of Denmark.
Yeah, I think I would start on a little higher level and sort of I emphasize that the pension funds in Denmark are obliged to try to create the highest return possible to their customers. And bearing that in mind, that of course also puts some pressure on the risk that they can undertake, because there are certain kinds of capital requirements that the pension funds have to live up to. And during the past years, many of the Danish pension funds have sort of changed from issuing interest guarantees, which is, as I understand from you, Cameron, still the case in the US. They have been sort of drawn back, so there's not many Danish pension funds that give return guarantees to their members anymore, but they still are required by the authorities to try to have the highest possible returns. And on that behalf, each of the pension funds boards will set up limits for different kind of asset classes and geographies in order to sort of try to manage the risks they are undertaking. Having said that, I think it's important discussing more investments in emerging market and developing market. It is important to try to illustrate to the pension funds this sort of gap between the perceived risk and the real risk at the one hand side, and on the other hand side also try to sort of inform the pension funds even more about the instruments issued by governments and such as ECAs and DFIs, but also the MDBs and the MFIs, because I think I have been very much surprised changing from the Danish ECA and into the private pension funds, meeting new colleagues that were not aware of the instruments and actually the sort of impact of the instruments. So I think in order to try to increase the investments in emerging markets and developing markets, not only in order to sort of support the emerging markets, but also in order to create returns, because I'm totally agree with you, Cameron, there are very good returns out there. I think it's important that we help each other to sort of share the knowledge of these instruments and thereby incentivize the pension funds to do even more investments in emerging and developing markets. Was that clarify something to you, Akif?
Yeah, and I'll just add that, Akif, that as you probably know, Convergence is helping invest, and a number of other donors, including DFID, CEDA, the EC, come together around this subject of driving scale investments into emerging markets, centralizing the learnings around the different vehicles to do that, including the SDG fund, and sharing that knowledge both with donors as well as with the pension community in different countries. So we're looking forward to bringing that body of evidence forward to both the private sector and the donor community so we can start to work smarter.
Great, absolutely. There's a lot to unpack there, Cameron, Annette, and Sundeep. Time flies when you're having a rich and interesting conversation. I've just realized we're 40 minutes past the hour, so we need to move on to our next segment. I have the pleasure of introducing His Excellency Mothanna Gharaibeh, the Minister of Digital Economy and Entrepreneurship in Jordan, for his intervention. The Minister will be making some remarks on the topic of investing in technology as a path to more resilient economies. So Minister, over to you.
Thank you so much. Thank you, Akif. And thank you all for dedicating the time with us at such hard times in every country on this earth. I mean, we're all suffering from a global challenge that we need to work together to solve it. I can start my normal pitch like everybody on earth saying why you should invest in Jordan, but I'll tell you a short story first. Last year I was in San Francisco visiting some of the companies to convince them to come to Jordan, and actually they came. But right, I came from the airport, my team, it was Eid, it was the national holiday. And my team were visiting the border guards during the Eid, during holidays, because they're alone protecting our borders from different challenges. And I wonder, one border guard, it's right on the borders with Syria. And it was quite interesting to hear them tell us the story of their life. right? A few hundred meters away, there was ISIS shooting them for many years, and they have received 400,000 refugees over the years. That's a refugee every 6 minutes. Those people, those around 500 people, they received refugee every 6 minutes for 3 years. And there was 0 violations recorded or registered with the UN on the whole process. That's Jordan. It's a Jordan where it's a country where you can really invest and create profit and make a real impact. It's a country where we have 28% of our students in public schools who are refugees, and they're taking the same level of education, the same care that the citizens have. Let me tell you even a more complicated story. Last year, we had a teacher strike for a month, and none of the Jordanian students took a single class that month, but all the Syrian students took all the classes. The teachers of Jordan did not use refugees against their government. That's our country. This is what we do. We're the sanctuary from the storm in a very tough universe. It's really hard for us to manage and to secure a proper life for our citizens and our guests through all those challenges. But yet, we're trying our best, and we're trying to make it happen through technology, because technology is a tool for justice. It democratizes opportunity globally. And that's why during lockdown, I mean, like any other country on earth, we had 2 months of full lockdown. People were not able to move. Yet, companies like Cisco managed to hire 250 people in Jordan from their homes to serve their global customers. 60% of those were females, serving their global customers globally, and yet they have recorded their KPIs, and they were the highest customer satisfied, they registered the highest customer satisfaction globally for the 6 core centers globally. We had Juniper open center in Jordan. We have Singaporean, American, we have Microsoft, Amazon, and everybody were hiring in Jordan, expanding during lockdown to serve the global customers. Why? Because we have the people who are skilled, who are committed, who are passionate, who make a difference on this earth, and because they need an opportunity, they need to survive, they need to live, they need a job. We have the infrastructure that we're able to take a huge load on the internet. The moment we announced lockdown, everybody was home, everybody was watching videos. I think everybody who's in Europe has suffered from lower quality on Netflix and YouTube. And actually, Netflix and YouTube were asked to reduce the quality to have the infrastructure take the traffic. In Jordan, we managed in a week time to put all the curriculums on a platform where millions of students were taking their classes online through a Jordanian startup, which did this in a blink of an eye. I called them on a Friday evening. Saturday morning, we were meeting with the Ministry of Education. In a week time, we had a working platform having all the videos or the classes for the Jordanian students. And it continues to improve. At 70% increase of the internet traffic was manageable within the infrastructure we have. We have thousands of kilometers that are built through the fiber that the state has built, and we're working with IFC to open it for public-private partnership as we speak. It works. It makes sense in Jordan. IT makes sense in Jordan. It actually has proven itself as a good model for investment and a good model to create opportunities for our youth and to have high quality services for all the global companies that have used us. And actually, it is cost competitive. I mean, people have the impression that no, it's higher cost. If you look at it, people with 2-3 years experience will be lower than $15 an hour. And that's a global competitive person hour cost. Not only that, we're working with the UNDP, and I really appreciate the great support we're getting from the team in Jordan who have done a lot of this on regulating the social entrepreneurship and social enterprises. We have those legal challenges that, like anywhere on earth, and we as a government are committed to removing all those barriers from the social enterprises for the companies who are established to serve a purpose, to do that with minimum requirements to move forward and be able to scale and serve the purpose they are designed for. I really appreciate giving me the time and your attention, and thank you so much.
Thank you very much, Your Excellency, for those remarks. I think COVID has really reminded us how dependent we are on technology and how reliant we are on technology. So I think your remarks are very, very pertinent. and relevant specifically for these times. So thank you very much for that intervention, very much appreciated. We're going to move on to the next segment of the program, which is the Q&A segment. So I encourage you to input your questions in the Q&A box, and I will read through them, and I will then allocate them to the relevant panelists accordingly. So, Cameron, we have a question over here that builds off of something you mentioned a little bit earlier in terms of data, transparency, and again, the reality and perception of risk. And this question specifically pertains to the GEMS database, the Global Emerging Markets Risk Systems database. Cameron, maybe you can tell us a little bit about what this database is and why do you think releasing this database potentially publicly, which I know there's been some discussions around, would be very relevant, would be very important, and perhaps why that would actually help us potentially see more flows to geographies such as the MENA region?
Well, I'm not a DFI, but I'll give it my best shot. The GEMS database is really the body of data that has been collected by the MDB and DFI community on their investments. And in order to broaden and in many ways, I think accurately, democratize, the term is correct, democratize investments and investment opportunities in the developing world, this database should be shared with the larger community. We've seen a sea change if you think back to the 1960s and 70s in the Bretton Woods system that was sort of the architecture of development finance in the beginning. Back then, 80–90% of flows to the developing world were public funds. Now that dynamic has flipped, and 80–90% of the flows are private. So why not take the body of evidence that donors have? Because at the end of the day, the shareholders of the MDBs and the DFIs are donors. Take that and provide it to a larger audience so that this perception of risk can begin to come down, right? We need to have the data of the longest standing investors in these markets so that other investors can begin to understand the actual risks instead of being up here with their perception of risk because they don't have enough information. And in looking at the question, the larger question, Hubert's question, I fully agree with him, quite frankly, on the second part of his question, which is, I would go even further than the GEMS database and say, you have a portfolio in these markets, MDBs and DFIs, of operating investments, i.e., these are the best investments in these markets that have been due diligenced by public institutions. They've invested in them early on so that greenfield and construction risk are now gone. They're seasoned debt and equity. Why not securitize them and take them and give them to the private investment community so that you can start lending and investing in the riskiest projects again. We were with Tim Turner in the early days at African Development Bank down in Abidjan when he formulated his Room to Run program with Andrew Holmes. We applaud it. There should be more of that, and there should be far, far less reticence in moving those assets to the private sector, in our opinion.
Great, Cameron. Excellent point about securitization. I think another example that might be instructive to our Jordanian colleagues and colleagues from the region potentially is IFC's Managed Co-Lending Portfolio Program Infrastructure Fund, which has managed to crowd in about $1.5 billion of funding from the likes of Allianz, AXA, and Prudential. and they're really looking to deploy that across infrastructure projects in the emerging and in developing markets. Sundeep, if I may direct the next question to you, because I think you'd be best placed to answer this, given your KEPFIC hat and your interaction with the Treasury in Kenya, the various regulatory community in Kenya. Sundeep, what is one sort of or two concrete pieces of advice you would give Jordanian regulators in terms of attracting FDI or indeed even portfolio investment to the country? And would that advice differ if they are looking to attract impact investors versus mainstream institutional investors? Sundeep, you're on mute.
Yeah. Okay, if I'm not sure whether I'm best placed to answer that, but let me take a stab. I feel that a sandbox regulatory environment framework would really help in terms of testing certain aspects, right? So I'm not so sure I can comment about attracting international investors, but in terms of attracting local pension funds, I mean, we've had a situation where our capital markets authority as well as our pensions regulator have allowed sandboxing of ideas and initiatives that I feel could be tried. I'm not quite sure I can add much more than that, Akif.
Cameron, do you want to add something from a regulation perspective? Or Annette, even?
So with KEPFIC, we were not involved as much in the regulatory aspect of that. That was really championed by the World Bank. But I will say that what we, I feel, brought to the table was a greater understanding of investment in unlisted opportunities among the US community that then hopefully will inform the body of knowledge and expertise in Kenya and also lead to potential regulatory reform. In general, our view is that the more we can open up investment in countries, the more we can drive domestic savings into the real economy in these countries, the greater impact we will have, and the greater mitigation effect we will have on certain risks that are very high on the list of international investors, such as currency risk. Mm-hmm. If you're financing projects and businesses and matching currency to a certain degree, international investors are going to be willing to take a smaller percentage of that currency risk if they have a strong local partner that's driving local currency finance into those projects. So we think it's a win-win if we can encourage governments and regulators to mobilize their own savings into their real economies rather than other investments which might be convenient at the time.
Great, thank you, Cameron, and thank you for also bringing up the local currency piece, because I spent a lot of my time thinking about that, and I think that's a really, really important element for regulators and for the entire community to think about as they look to attract these funds into these regions. Annette, maybe I'll direct the next question to you, and that's more around investing in climate finance and climate funds. I know that you guys have done a great job with the Danish Climate Investment Fund. Maybe you can introduce, the Danish Climate Investment Fund, tell us a little bit about what that is, and maybe tell us a little bit about what kind of geographies the Danish Climate Fund is investing in, and any activities to date that you think might be interesting for this audience.
Yeah, I think I refer back to my last slide, because the climate fund, the Danish Climate Fund, and basically also the Danish SDG Investment Fund are both based on this preferred return model. And back in 2015, I think it was, the Danish Climate Investment Fund was established, and it is managed by IFU, which is the Danish DFI. A vast majority, if not all, the investments in the Danish climate investment funds are made in emerging markets, that being Africa. I think actually also some of the investments is in the MENA region, Latin America, and Asia. So it's I think a majority of the investments in the Danish Climate Fund is wind turbines. Some of you might know that Denmark have two suppliers of wind turbines, which is Vestas and Siemens Gamesa, and that's why, I mean, Danish pension funds, DFI, called IFU, and the Danish Export Credit Agency work so very much together. It is actually to secure the export of turbines also to emerging markets. And I can say that in the Climate Investment Fund, I think there is, the returns are not amazingly good, because we have some investments, particularly in one country, which I will not mention, but with problems due to actually, and that should be my point, due to actually the local government changing some of their regulations in the PPA between the project and the government. So if I should give the politicians in the MENA region one very good advice to attract money to investments in infrastructure and other projects, it is very important, if you go to the international financing markets, that politics are foreseeable and steady for a very, very long time, because otherwise you would risk the ability to attract international financing in anything if you sort of damage that sort of contract between the investors and your countries. And I mean, that not only goes for infrastructure projects, it goes for any project. And I think Cameron, I can see you are nodding, because you tried that kind of situation as well. The SDG fund, if I may also just give a few words on that, it's not narrow to, it's not exclused to only doing infrastructure and energy projects. So we are also investing in hospitals, and that's actually in the MENA region, and also to some kind of education systems, also in the northern part of Africa, and other kinds of sort of SDG related investments. One thing that you've said before, Akif, which continues to surprise me, is that it is actually very hard to find good projects in the emerging markets. So perhaps some of the government entities or public owned entities should try to help each other to find the good projects, because I think if we work together to be able to find the good projects, the money flow would be much easier. But I mean, having worked with the Danish ECA for 18 years, and we've always discussed why is it so hard to find the good projects. So I think that's also one way, one instrument that one should try to work together to develop. And again, I would like to encourage institutions and governments to work together, because I mean, the knowledge is out there, the capacity is out there, but working together, that's I think that would create much better result than we have historically been able to do.
Great, Annette, thank you for that intervention. I think you brought up two interesting points. One is definitely around the political risk across these particular geographies, which I think needs to be borne in mind. And then the second important point I think you made was around building project preparation, bankability, and origination of projects. So maybe Sundeep, if I can turn to you to build on that a little bit. How do your the members of KEPFIC, how do they work to originate and arrange some of these projects within the infrastructure space and to build this pipeline of quality projects that potentially might be attractive then to developed country counterparts from a co-investment perspective? Could you maybe talk to us a little bit about that process and how that actually plays out on the ground?
Sure, Akif, that's an excellent question. I mean, we've had, in the last 2 years, we've had more than 24 propositions that have been put to KEPFIC. Some of these come from member institutions who have been approached by others. We have the public-private, we have the PPP unit at the National Treasury, which, as I mentioned earlier, have got about 70 projects in need of financing, all at various stages, and they're fully listed on the National Treasury's website. We have, and as word got around about KEPFIC, we started getting approaches from local project people who were looking for financing. In many ways, we've had engagements with banks, many of the leading banks who have been financing these projects. And where we come in, as we discussed earlier, is pension funds providing the local currency component, but also the longer duration funding, right? Because banks, by their very nature, are limited in how long they can lend for. So we bring in the local currency financing as well as the longer maturity, and the discussions have been around what sort of premium, what sort of benefit do we get as pension funds for doing so. But the interest itself has generated a lot of propositions that come to us. These are vetted by our technical team at the Secretariat. We also invite our existing investment managers to review these because we are required to do so under the law. And one of the things that we're actually looking at is the possibility of recruiting a specialist infrastructure manager to be able to help us to evaluate these, or even creating like a pension infrastructure platform like in the UK. So we're getting plenty of opportunities coming to us. The challenge at some stage is our ability to be able to evaluate them within reasonable timelines and go through the process of engaging our trustee boards as well as our investment managers. So I think we are looking at seeing, can we get a specialist infrastructure manager? Do we get one manager, or do we have a technical team assembled for every proposition that we look at, right? So it's probably a combination of approaches that we will need to go for.
Sundeep, I want to come back to you, but I maybe go to Cameron to just pick up on a point over there. Cameron, what role potentially can donor agencies such as USAID and indeed maybe the rest of the OECD DAC community also play in preparing these projects, whether it's through technical assistance or project prep facilities? Because this is a point that keeps coming up. Not just whether you talk to pension investors, but even other sorts of investors as well. It's around lack of quality projects, bankable projects. So what kind of role can the donors play to facilitate and to build a quality pipeline of these kind of projects? And perhaps, Cameron, even if maybe not from an individual project perspective, but even bundling of projects might be a better approach as well than to think about it from that perspective, because you can structure around large ticket sizes if you bundle. You can, bundling also has the effect of diversifying the risk away. So, maybe your thoughts around that also, I think, might be useful.
It's a great question, and I think you need to bundle on both sides, both the supply and the demand side. What I mean by that is you do need to do project prep on the demand side, and there are several models for that. For example, we are exploring right now a technical assistance facility attached to a fund that will de-risk investments by that fund. So channeling donor technical assistance dollars to essentially make projects that a fund invests in more bankable. Now, technical assistance does not need to be attached to a particular fund. In fact, Invest has 11 technical assistance platforms that are devoted entirely to transaction facilitation. And transaction facilitation to us means making a transaction bankable for the private sector. So defraying costs of due diligence, defraying the costs of attracting capital to a particular transaction. All these things are things that we're actively doing. What's often lost in this discussion is how you bundle on the supply side. And Kenya is a perfect example of that. Many of the smaller pensions in Kenya and around the world cannot access the expertise that they need to make investments because many of the managers that have that expertise require a certain threshold. You need to invest a minimum of $10 million with us in order to access our expertise as an intermediary. Well, there ought to be a way for donors to help bundle that supply of capital, right? Defray the costs of bundling that supply of capital so that some of these smaller pensions, which don't have large staffs, which cannot access credible intermediaries, are able to pool their resources and access that expertise. But there's a variety of ways, I think, that donors can dive in and help to make transactions more bankable on the demand side, but also allow smaller entities to access the expertise they need to grow and make investments in the real economy.
Cameron, if I may just stay with you, I think there's a tremendous potential for US pension funds, as we've discussed, to collaborate and to participate in projects in the MENA region. Just for our colleagues in the MENA region to perhaps understand this a little bit better, in your experience in dealing with US pension funds from across various different states even, are there any sort of investment limits, portfolio ceilings in terms of geographies? If so, what does that look like?
There are allocation limits by asset class, by geography. They're not, I don't think, in many cases publicly known. And again, I think by and large, the US community is over allocated in mainstream markets, that's for sure. So diversifying by even 1%, let's say that the US community were to invest 1% of their assets in Africa, for example. That's $160 billion right there. So it can have a sea change in the amount of private capital flowing to these markets. And then the trend lines on allocations to different asset classes is also changing. There is a move towards alternatives in mainstream markets because of the higher returns. But that alternatives market is nearly exhausted, right? Because there's fierce competition for those markets. It's far less exhausted, right, in emerging markets. And the valuations, i.e., the amount of money you're paying for investments are much, much lower. So there are bargains, right? There are bargains in developing markets because it's not nearly as sophisticated that the pension community is now beginning to look at very, very seriously.
Great, and I think maybe Annette, I'll come to you to pick off on a little bit around this mentioning of alternatives. Of course, we spent a lot of time speaking about infrastructure within the alternative asset class basket. Annette, in your experience, sort of what are the other exciting alternative opportunities that you see in emerging markets and potentially even in the MENA region as well from an alternatives basket?
Oh, I would say that a big chunk of PKA's investments in alternatives are going into PE, private equity investments in the developed market. But continuing to work with IFU and other like-minded funds that invest in the emerging markets and the developing countries, we also see more and more smaller PE firms that we try to evaluate on behalf of risk and return and try to invest in. So more traditionally, private equity investments in the emerging markets are sort of emerging in more and more regions. We have seen some in Latin America, we've seen some in Africa during the past one and a half year. So more classic private equity in the emerging markets, of course, because of the success of that asset class in the developed markets or the developed countries, that is also emerging in other regions in the world. And I think that's a fortune for the developing markets, because that's a very good way to sort of pool investments into industries and companies, at the same time giving the sponsors some kind of mitigation to the risks involved in that asset class in new markets.
Great. I think there are some private equity firms on the call today, so I think what you're just saying is music to their ears. Hopefully there can be some collaboration to that effect as well. Sundeep, if I may come to you for the last question before we do some closing remarks. And I want to bring this back to infrastructure, because I know that that's been a theme that's of great interest to the Jordanian colleagues that we have on the line today. Sundeep, in your experience, of course, infrastructure assets, can help with this asset liability mismatch sometimes that pension funds have. You mentioned commercial banks, much shorter duration. And so, infrastructure really is a great sweet spot for a lot of these pension funds. In your experience, what sort of financing instruments or vehicles or investment routes have developed country pension funds typically taken when financing such assets in emerging markets? And are there any trends and patterns that you have seen in the work that you do?
Yeah, I mean, it's a good point. Both developing countries and developed country pension funds, I mean, their infrastructure investing is a good match to their long-term liabilities. For pension funds within Africa, I mean, we have seen that it's typically investing through debt instruments. So largely debt-driven financing. And from my experience, and for the very limited infrastructure investment that has taken place in Africa, most of it has been through debt financing by global pension funds. However, when I look at funds in Southern Africa, particularly the GEPF, like the government employees pension fund in South Africa, and I believe ESCOM, these funds have a mandate to invest across Africa. So they have a mandate to invest up to 10% of their investment in across Africa. They are looking at infrastructure, and they are looking at equity investing in African infrastructure initiatives as well. So we have seen several South African PE funds, several Nigerian PE funds investing in greenfield infrastructure projects. And I'm aware that pension funds in Nigeria, some of the larger PFAs, have also taken advantage of this. So it's a mixture. The preference tends to be debt investing, but given the very nature of infrastructure, at least in Africa, there's a fair amount of equity investing as well.
Great, thank you for that. So we're almost at the close of our session. I'm going to now request the three of you to offer up some closing remarks, and maybe if you can structure it in these three baskets. One is a key takeaway from today's discussion. The second is a key piece of advice that you would offer the Jordanian pension fund, SSIF, and indeed any other regional pension fund that's listening. Maybe a key piece of advice or a call to action. And then maybe one offer that you would have as a collaboration partner in terms of what can you offer this particular community in terms of next steps, because I really wanted to make this conversation as practical oriented as possible. You know, you can have a conversation that's very theoretical, but we want to make this as practical and as real as possible. So one key takeaway, a key piece of advice or a call to action, and then one thing that you can offer up as a collaboration activity that SSIF or indeed some of the other pension funds listening can take you up on. So maybe we'll start, ladies first this time, Annette. So maybe we start with you.
Okay, thank you very much. That doesn't give me very much time to think about my sort of answers to that very serious questions. I think my key takeaway, being the Jordan pension funds, should be that change is coming. There's light at the end of the tunnel. I think that more and more capital will, unfortunately, slowly be coming into the developing countries. Slowly, but I think the flow will increase. And I think my best advice should be to the Jordan pension funds and the Jordan politicians as well, should be to work together with pension funds from developing countries that are already sort of investing in your region, and try to sort of join forces in order to learn from each other and also to mitigate the risks. And my second advice, I've already given it in my earlier answers, but I would like to repeat it. I think it is important for local pension funds and local governments to work together with the DFIs, the MDBs, the IFIs, and so on and so forth, because there is so much investing capacity and network in these institutions. So I would very much encourage to work together with them as well. Thank you.
Great. Sundeep, if I may come to you next.
Sure, that has given me a little bit more time, Akif, to think than Annette had. I would say, look, I mean, it's always good to think of homegrown solutions that are tailored to meet the requirements of our particular countries and regions, rather than rely on imported solutions. I mean, I'm a very strong believer in having our own solutions to our own problems and challenges. I'd want to add that working together, venturing into the unknown is very daunting, but working together, there's a safety in numbers, there's a certain strength and a negotiating power that you have, which enables you to engage with all the stakeholders who need to be engaged, whether it's policymakers, whether it's international partners, and engaging with other stakeholders in the economy. So I'd say those would be my two messages. Go for homegrown solutions. Number two, work together. And KEPFIC is very, very happy to share our experiences and any ideas that our Jordanian counterparts might.
Great. And
really great.
Cameron, my friend, you have the last word.
Thank you, Akif. Well, very similar to my friends here, this has really crystallized for me the power of working together. And to some degree, pensions across the world speak the same language. That doesn't mean that US pensions are going to break out in classical Arabic anytime soon. What it does mean is they are all fiduciaries. And when they get together, when they engage, when they interact, opportunities arise. We started our program back in 2017. We had some vague idea of what we wanted to achieve. But our first and foremost, our near-term objective was to get African and US pensions together to talk about what they may not have seen yet together. And that has borne fruit, both in dollars as well as deep, deep relationships. So my advice to the Jordanian community is to organize, interact, engage, both within your borders and beyond your borders. And what I can offer, of course, is to open up our community of practice and what we have learned to them, to share ideas, to participate in that interaction as much as possible, given the constraints these days.
Great, thank you, Cameron. Thank you, Sundeep. Thank you, Annette. I think this conversation has been very practice-oriented rather than theoretical, and that's really what we wanted to achieve. From all three of you, there's some really interesting examples in the work that you're doing on a day-to-day basis that I think can form a lot of key takeaways for our Jordanian colleagues in terms of follow-up actions, whether it is potentially to form something similar to KEPFIC within Jordan, within the MENA region, whether it's thinking about how we can do a MEDA type of initiative within, again, the MENA region in Jordan. A lot of interesting examples, Annette, from you've shared around the SDG investment fund, the climate investment fund, that I think might be replicable from a regional context as well. So I think there's a lot of practical points that all three of you have made that would be very much appreciated, I think, by our Jordanian colleagues. So thank you for that and for sharing your time and spending your time with us today. So that's all I have. I'd like to bring back Rasha. I can see Rasha's turned the camera on. Rasha, over to you for some closing remarks and to bring us to the end of these 3 days of rich discussion. Rasha, back to you.
Yes, very much appreciated indeed from all of us in Jordan. We were really hoping we can host you in Jordan, and we're still hoping that'll happen sometime soon, as soon as travel goes back to normal. It's been a very insightful conversation. I'd like to thank all of you, Cameron, Anette, Sundeep, and Akif as well, and all our speakers over the past 3 days. We are going to be circulating a white paper with main takeaways from the events with everyone registered. So you'll be receiving that by email. I think if we did a word cloud of the most said words during the past 3 days, collaboration would be first and foremost. I think that word must have come up between every other sentence, and that was a big driver for us doing the event. We wanted to create the space and the platform for the Jordanian pension fund and the regional pension funds to be able to build these bridges with European, US, and Canadian counterparts. We're really hoping we can work closely with the development community to create a network of pension funds that are like-minded and that are moving in the same direction. And I think the other main word that comes up over and over again has been long-term, and it's having a long-term approach to solving these societal challenges. I would like to introduce and hand over to the head of the United Nations Development Program here in Jordan, Sara Ferrer-Olivella, for her closing remarks.
And thank you, Akif. You just made my job much easier because I was meant to provide some key takeaways from this session, and you asked each one of the speakers to give us the takeaways. So perhaps just I would like to do now is just to thank Anette, Cameron, Sundeep, and you, Akif, basically for highlighting very important points, and this is very much what we wanted to get out of this conversation, which is basically your insights, your views on how actually we could, first of all, bring this experience to a larger audience, also to benefit our counterparts, not just in Jordan, but also in the MENA region. Annette said volatility is everywhere. And one of the things that you actually, all of you touch was on this issue of perceived versus real risks. And what can we do as a community to explain and to highlight, and I think to highlight why it makes sense to also look at these markets at potential investment opportunities. So Cameron, you were very, there is a need clearly to heighten the awareness on these investing opportunities. And for that, all of you mentioned the issues of building capacities in the boards, building capacities in the community, taking people in road shows, very important. And the example of the USAID in Africa and this MEDA initiative, fantastic work. Also partnering with local funds, local pension funds, as we were seeing from Kenya, as a great opportunity to learn more about these countries. Also, I was very, Anette mentioned very clearly the issue of highlighting good projects. What are those good projects? And here you have defined different, whether bankable, investable, and what are some of the tips that we can also take away as well to project some of the opportunities. To thank Mr. Mothanna, who was here with us. He is an excellent minister in terms of pitching the country as a great investable opportunity. And I think the tech business case for Jordan and the region also allow us for that. Thank you, Minister Mothanna, for being with us today. Also, I think it was also very clear that there are lots of instruments and tools out there, but not necessarily everybody knows about them. So the point that you all made, and I'm just going to reiterate, is the need for collaboration between public and private, but also among the regional actors, among development banks, among development partners, and how this community actually can, in many ways, through blended finance and other means, technical assistance, can facilitate this access to these markets and start improving, the percentage of invested funds in the MENA region in the global institutional large investors. Just to say, I wanted to take this opportunity together with Russia to close this conversation series today. And this event, Russia said, we still would like to have you in Jordan, all of you, and interact with our partners here, which are fantastic. This is a journey, and a journey that we started a couple of years ago. And, this series today, it's basically our commitment to building forward better. And as our administrator, UNDP Administrator Achim Steiner said yesterday, we cannot do that alone, we need all of you. And so the pension funds and other institutional investors can play a critical role in financing sustainable development, but also on how responsible value-based investment can drive and shape a sustainable recovery. So here in SDG Impact Jordan, a flagship of the UNDP, is basically our role has been to raise awareness for the business case in aligning with the SDGs, and also to identify business opportunities that could be of interest to all of you. As we move forward, and scale this initiative, we really would love to work with all of you, whether it's government, whether it's the investment community or the private sector, really to set the building blocks of this impact economy. And I just would like to leave you with three thoughts that have resonated with me over the last 3 days. And it is clear that in these discussions, in these conversations, this impact economy, it can only be collaborative across sectors, across boundaries, across generations. And, we had analogies earlier on about we work together as a team. Russia makes sure that we are, investing in the weakest link is the true answer actually to unleashing the power of the team. Our Shams, who moderated our first day, also mentioned the issue of synchronized rowing teams, which I'm very familiar with, and as all these pieces need to connect together. And I think all of you emphasize the need for this, actually, to unleash the power that is available in terms of know-how and also financing. This impact economy is also driven by a long-term view, but a long-term view that is purpose-led. And what is this purpose? It's a purpose that tries to address the challenges of today and tomorrow in our economies and societies. So this is the SDGs, in our mind, provide that opportunity, that framework of investable opportunities that could be tapped into. So we can move into this impact economy space in a much more deliberate way. Lastly, I just wanted to highlight the fact that we are looking at this impact economy. Basically, it is a holistic endeavor, and a holistic endeavor that you have all touched upon, that requires of all actors coming together. But I would like to actually emphasize the fact of the large institutional investors, whether they are international or local, they have a critical, the decisions you take affect all of us, and the influencing of positive behaviors are just critical for better society and economy outcomes. So, you know, really, I would say, stick with us, if I may say this colloquial term, because really we can see it's a win-win proposition. You know, in Jordan, in the next phase, we are looking at supporting the Social Security Investment Fund to further explore many of the issues you touched upon today, and certainly provide and bring the different partners in terms of how we could create this platform of collaboration at the local level. I would like to finish, first of all, by thanking the Prime Minister Razas, who was here with us on the first day. Also, Minister Mothanna, who is a great champion and leader in championing the impact economy in Jordan. Also, I would like to thank also our administrator, Achim Steiner, who believes in this and globally is championing the SDG impact. Of course, I would like to thank all of you who have joined us over the last 3 days, the magnificent speakers that we had, the moderators, and I would like actually to pay particular thanks to Russia, who has been the SDG Jordan Impact Lead and has brought all of us together in these conversations. Hulut, who is the CEO for the Pensioning Fund in Jordan, is our co-host. So together with her, we thank you all for being with us and sharing your valuable contributions. Over to you, Rasha.
Yes, just to say a final thank you all for your time. Warm regards, bye.